big idea with GST 2.0 is there is a movement towards two main rates, the 5% rate and the 18% rate. A big chunk of GST revenue actually comes in from the 18% slab. Can macros and GST 2.0 revive consumption in India? Are we about to see India's consumption come back to life? Or will it be another poor season? Let's get into it. Inflation has cooled fast. Government capex is the strongest that it's been in a few years. The rupee feels steadier, and the big GST cleanup or GST 2.0 is coming. And that means things could get meaningfully cheaper for all of us. But there is a little bit of a catch here. We're seeing valuations are still a little pricey. Earnings for corporates still continue to hover in the moderate zone and are probably weak. And there is a lot of retail credit stress that we're seeing, which is inching up slowly. Over the next 2 to 3 quarters, what is going to be interesting is whether consumption comes back or if that sort of overvaluation story and the lack of consumption story continues to exist. So let's unpack this in today's video to understand why GST is such a big deal, what are the macros that are important from a consumption perspective, how cash in women's hands is actually improving from the ground up, the consumption story, the consumption revival that we're seeing in the economy as well. We will also look at how corporate earnings and valuations are sort of shaping out during this phase. And finally, we'll answer the question, can macros and GST 2.0 revive consumption in India? So let's look at the macros. Let's start with the prices. Headline inflation, as you can see in the graph, has fallen sharply compared to last year. Then this is also under RBI's 4% comfort zone. And this matters because the biggest break that's there on spending for consumers is the feeling that everything is getting a little costlier. And when that fear fades away, people try to potentially get into smaller upgrades. They may go towards buying more sort of branded atta, maybe a new mixie, a new TV for the house, anything that makes sense. All those discretionary spends sort of come into the picture. And interest rates also start helping. With the inflation low, the policy stance from RBI as we move into the festive quarter becomes more steady. In the festive season, EMIs for, let's say, two-wheelers, entry-level cars, appliances, all of this can feel less painful, and it can feel less of a drag for the middle-class family, where even 100 rupees savings on interest each month can add up to a significant chunk over the long term. Now, with the friendlier monsoon from the outlook for August and September, this means that there is better farm incomes. It means that there could be potentially a stronger October to December quarter as well, where the spending from rural and semi-urban India, the zones that actually typically swing a lot of the volumes for our mass brands for consumption, could improve. So on to the main story here, which is the GST 2.0. The big idea with GST 2.0 is that there is a movement towards two main rates, the 5% rate and the 18% rate, with a higher rate for luxury items. By cleaning up the slabs, fixing these weird tax gaps that are there, and sort of cutting prices across mass categories, there is the hope from GST Council that this could revive consumption, and if it lands especially before Diwali season. And here are some of the things that you can see. So for instance, items that are currently sitting at the 12% mark, for instance, let's say processed foods, footwear under 1,000 rupees, wellness category, Ayurveda, all of these could move into the 5% bucket. And that's a direct impact on the consumer's pockets because that's a direct cut on the price. And for people that were potentially looking for unbranded versus branded, for instance, that smaller price gap can make the difference for the branded feeling more worth it potentially. There are also some durables such as which were sitting at, let's say, 28% earlier, like large TVs, AC models. These could potentially shift to the 18% mark, and that's roughly nearly an 8 to 10% drop on the actual price of the product. And we would see this really have an impact on the tier 2 and tier 3 buyers, where the nudge needed to stop browsing and start buying really comes in from the pricing mechanism. Beyond durables and consumables, we also see potentially, let's say, cement, which could get some relief from the 28% bracket, which would mean potentially home improvements could become cheaper, and that could fall into, let's say, paints, fittings, wiring, etc., also getting cheaper potentially. The luxury category isn't going to get any sort of rebate here. It is going to get higher in terms of expensiveness, and that's just how it is. Now, the interesting thing here is that a big chunk of GST revenue actually comes in from the 18% slab, which is nearly around 60 to 70%, as you can see in the graph. So the GST Council has to take a very important decision here in terms of what goods are going to fall into which which categories, because the shift of most of the basket from, let's say, to the 12% down to 5% and keeping the 18% slab largely intact, that could have a hit on the revenue for GST for the government. But maybe the stronger volume that they perceive with consumption coming back could actually earn majority of that loss back in within a year or so. Now, the second part of the story is the direct sort of cash outlay that is happening from states into women's hands, and this is happening on a recurring basis of, let's say, 1,000 to 2,000 rupees coming directly into the bank accounts of some of the women that are running these households. Now, when you start thinking about it, this money goes towards what end use is typically staples, kids' clothes, basic cosmetics, kitchen upgrades, those sort of staple, very core spends that need to happen at a family level. And this is happening across many states, as you can see in the table here, where the overall outlay for FY26 is sitting at about 1.5 lakh crores. That's a huge amount that can be spent on essentials and affordable discretionary items as well. And now when you pair this side of the story with the better farm incomes, the lower inflation, the better monsoon that was happening potentially, that could lead to something that we've not seen in a while, which is that the rural wage growth starts beating price growth that's happening or inflation that's happening. So from a consumption revival perspective, GST rationalization that we've spoken about is just one of the few levers that is available to revive household demand specifically. The second lever here is also sort of having better farm incomes, the women-centric transfers that we've spoken about. Crop procurement prices have moved modestly higher, and with Kharif output looking for a second year of above average trend yields, rural wage growth can ultimately keep pace with the inflation index for at least a few consecutive months to July, something that hasn't really happened since early 2021. And finally, the third lever is disinflation. The fall in headline CPI that we've seen translates effectively into real disposable income gains for both urban and rural households and wage earners. And ultimately, when we look at, let's say, some of the commentary that we're seeing from corporates for the June quarter, we're seeing some of the effects of this turning happening. And that qualitative story is also being seen in some of the quantitative side of the things, where we can see, for instance, quick service restaurants, FMCG, staples, paint companies. All of these are sort of moving upwards, inching upwards during quarter one of FY26 after having a rough patch in FY25. But this improvement in consumption is not necessarily fully uniform, nor is it fully secure. Inventories for many of these companies remain at an elevated level with cooling, let's say for instance, cooling appliances after an early monsoon cut into, let's say, the April demand that we would have seen for summer. Retailers also confirmed, discretionary apparel sales are recovering faster in tier 2 catchments than they are in metros, for instance. So consumer sentiment surveys are still showing cautious optimism rather than sort of this big exuberance of consumption coming back. Finally, we start moving on to the corporate earnings and the overall valuation picture here. So India's macros are looking good, but the corporate earnings is still something that's not doing as well. When we look at the upgrades to downgrades index for quarter one of FY26, that was sitting at about 0.69. So that's been 4 quarters where it's been below the break even of number 1. Street estimates of FY26 are again showing that there is a trimming down of the revenue, with about it falling by about 1%. EBITDA is again down by roughly 1%, and profit after tax is expected to be down about 1.5%. When you look at FY27 numbers, however, the overall commentary and the expectation remains intact, which is a way of the market sort of saying, there's a bit of time, there's not too much, and we're expecting you to sort of deliver in the second half of the year. So valuations aren't cheap enough to not care. The Nifty 50 sits at about 1 standard deviation above its 5-year forward price to earnings ratio. Mid caps are closer to their mean, and when you look at small caps, for instance, they're looking about 2 standard deviations cheap. But cheap can stay cheap if the earnings don't show, which is why the next few months really matter in terms of what we're gonna see here. So can macros and GST 2.0 revive consumption? Yes, if the policy lands on time. If there is a cleaner GST bill where the cuts are actually happening for the mass market, and that lives and that sort of gets translated to bottom of the funnel sort of savings. Plus there is disinflation and steady interest rates. This could be the exact thing that India needs to revive its consumption. With that, we're also seeing, like we discussed earlier, the women-led direct benefit transfers that are happening. happening. There's been a very strong monsoon this year. So all of that points to a healthier outlook for the consumption cycle. Now, what it depends on is if the GST Council is able to act on this by October, so that when we enter the festival quarter, the demand can sort of can be pulled forward, which helps improve earnings and justify some of the valuations that we might be seeing for some of these companies today. If the GST Council or the overall policy for GST 2.0 gets pushed into 2026, we will probably see a little bit of a pause where the earnings may start seeing a little bit of trimming. Multiples may cool off before we sort of enter the next leg of the cycle. And in that world, potentially mid caps that could be operating with, let's say, clear operating leverage, have sensible valuations, could be attractive. So the next 2 to 3 quarters is what will ultimately determine whether India really turns the potential that's there into the performance that we are expecting, and that will translate into more consumption, which will hopefully drive the corporate earnings and the broader economy forward, or whether we sort of keep waiting for a bit longer for that cycle to kickstart. We hope you liked today's video. If you liked it, do share, comment, and subscribe. Do let us know in the comments what other videos you would like us to cover. Happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.